You know, for months now, the market's been telling itself this really comfortable story. Well, that story is officially over. Today, we're diving into a fundamental shift in the global narrative, a move away from that easy optimism and into a stark new reality that a lot of institutional investors are calling a regime change. So let's break down exactly what that means and why it's all happening right now.
Yeah, this one sentence from a recent institutional research note, it just nails the mood perfectly. The dream of a soft landing. This idea that inflation would just kind of gently fade away without wrecking the economy, that's evaporating. We are now at a painful turning point where the market is being forced to wake up and confront a much, much harsher world.
Okay, so what is it that's killing this whole optimistic story? Well, the evidence is pointing to what we're calling a triple threat. Three interconnected risks that are all converging at the exact same time. We've got stubborn inflation, escalating geopolitical conflict, and these hidden cracks in the credit markets. Look, this stuff isn't just background noise anymore. It is the main signal. And the alarming part, the market still isn't fully pricing it in. All right, first, let's just be crystal clear about the dream we're talking about, the one that's now over. The soft landing was this perfect scenario, right? Inflation would gracefully fall back to its 2% target, which would let the Federal Reserve start cutting interest rates and, keep the party going. It was a great story, but that's all it was, a story.
So our investigation starts with the first piece of evidence that really shattered this dream: cold, hard economic data. The numbers themselves are directly contradicting that optimistic narrative, and they're forcing a major and pretty painful reassessment. This one number right here is really at the heart of the whole problem: 2.8%. That's the core PCE inflation rate, the Fed's favorite measure, and it's stuck. It's just not moving. This proves that the last mile and the fight against inflation is by far the hardest, because all those sticky costs, services, housing, they just refuse to budge. The easy wins are behind us. And check this out. These two charts, they do a brilliant job of showing why inflation is being so stubborn. Over on the left, you see jobless claims are staying incredibly low. That signals a labor market that is just persistently tight. Some people are even calling it a jobless boom, where companies are basically hoarding workers, which keeps pushing wages up. And that leads you directly to the chart on the right: rising Treasury yields. The bond market is waking up to the fact that the Fed can't cut rates. I mean, the conversation is now shifting to whether they might have to hike again. Yeah, hike.
Okay, let's pivot to our second clue. And this one isn't about spreadsheets and economic data. This is about a conflict happening half a world away that is having a direct and immediate impact on every single portfolio out there. And listen, this is really important. This is no longer some tail risk or a what-if scenario. Prediction markets and key defense sources are pricing in a 70% probability of direct military action. When you see 2 carrier strike groups deployed, the largest deployment since 2003, that tells you everything you need to know. We've moved way past diplomatic posturing. This is active preparation. For the market, this is now the base case, not some fringe possibility. So what does the market do? Well, the reaction is exactly what you'd expect. It's swift and it's logical. As you can see, capital is flowing out of assets that get hurt by uncertainty, and it's flowing into things that actually benefit from conflict and inflation. Brent crude oil is surging, defense stocks are hitting new highs, and investors are running for cover in the traditional safe haven of gold. It's a classic risk-off rotation into real assets. All right, this brings us to our third clue. And honestly, this one might be the most dangerous of all, because it's been lurking in the shadows of the financial system, mostly out of sight. Well, until now. So where is this ticking time bomb hiding? Well, it's in the absolutely massive, kind of shadowy, and pretty lightly regulated world of private credit. This market has just exploded since the 2008 crisis, and it's about to face its first real serious stress test. And get this, the first domino has already fallen. Blue Owl, a huge player in this space, just slammed the brakes on redemptions from one of its funds. Now, for anybody who studies financial history, this should send a chill down your spine. It's a scary echo of August 2007, when the French bank BNP Paribas froze its funds, which was the first real public tremor of the subprime crisis. This isn't just another headline, folks. This is the canary in the coal mine. Okay, so what is private credit exactly? Let's break it down. The easiest way to think about it is like a shadow banking system. See, after 2008, all these new rules made it tougher for big banks to make risky loans. So non-bank lenders jumped in to fill the gap, and they created this massive $1.8 trillion market that operates outside the view of most regulators. The problem is, with interest rates staying higher for longer, the weaker companies in these portfolios are starting to break.
The scary part? A crisis here could absolutely trigger a much, much broader credit crunch.
Okay, this is where it all comes together. You have to see how these three clues connect and feed on each other. It's a dangerous feedback loop. Geopolitical tension pushes oil prices up. Higher oil means higher inflation, which kills that soft landing dream. That stubborn inflation forces the Fed to keep rates high. And those high rates put incredible stress on all the hidden leverage in the system, like in the private credit market. Eventually, something breaks. A credit event happens, and that threatens to spill over into a full-blown systemic crisis. That is the triple threat in action.
So, okay, that's the problem. And yeah, it's a pretty grim picture, I get it. But just understanding the risks is only half the job, right? Now we need to talk about the strategic response. Let's dig into the survival playbook and see how institutional investors are repositioning their portfolios to deal with this new regime. And the playbook is pretty straightforward. A major rotation is happening right now. You're seeing money pour into sectors that can handle this kind of environment. That means energy and defense get upgraded to overweight because they're direct hedges against inflation and conflict. On the flip side, money is fleeing the vulnerable spots. Software companies, whose crazy valuations really depend on low interest rates, they get downgraded to underweight. And financials also get a downgrade because of their direct exposure to the exact credit risk we just talked about. And really, this right here sums up the new mindset perfectly. The game is totally changed. When you're in a regime change, the main goal is no longer about chasing the highest possible returns. Nope. The number one priority shifts to risk management and simply the preservation of capital. It's all about surviving the storm so you actually have capital left to put to work when the sky's finally clear.
You know, I want to leave you with this really infamous quote. The CEO of Citigroup said this. He said it in July 2007, just months before the whole system came crashing down. It's the perfect example of that dangerous mindset, right? Ignoring all the warning signs just because things on the surface still feel okay.
And so here's the final verdict from our deep dive today. The warning signs are flashing bright red. The feedback loops are already in motion. For all intents and purposes, the music has stopped. And history tells us over and over again that when the music stops, it is way, way too late to start looking for the exit.